Hello and welcome to yet another edition of Who Moved the Market. It is Monday. We are back with Market Conversations and I'm your host, Surabhi Upadhyay. Well, if you have noticed some of the oil and gas stocks off late, you might have seen that they've had a pretty decent rally. In fact, even today on Monday, there is some incremental buying that we're seeing on a couple of the oil and gas stocks, particularly some of these fuel retailers. I'm talking about names like IOC, BPCL and HPCL. So what's behind this move and why is it that some of these stocks, like IOC in particular, why have they rallied 20% already in this year? Well, to help us understand this and demystify the sector a bit, we've got Sonal joining us. She's back in the house. Sonal, thanks for joining us again on the show.
Thank you so much. And interesting moves there, right? In FY23, or I would say calendar year 2022, it was not the best time to get into the oil and gas space.
Yeah.
But looks like the tide is turning. And you spoke about oil marketing companies specifically. And that is the sector, or that is a segment which is seeing a lot of tailwinds. One, of course, we've been talking about if at all it could happen, that would be a fuel price cut. And that could happen. It's because their marketing margins, they are at a record high right now. In calendar year 2022 or FY23, these companies actually reported losses both on the petrol and diesel side. They hadn't taken any price hike since April 2022, despite the way crude prices moved. Now remember, crude prices touched levels of $100 in October, and despite that, they did not go ahead, pass it on to consumers for a couple of reasons. They spoke about how inflation was very high, and they did not want to give it to consumers. So they did not go ahead, and they took that hit. So as per a Motilal Oswal report, they were making losses of around 10 rupees on diesel and around 1 rupee on petrol, and that is the reason they reported huge losses in Q2 and Q3.
Right.
And now that looks like could be reversed because crude oil prices, they have come down. And now, according to the report, they are making profits of 10 rupees on petrol and 12.5 rupees on diesel. So basically, that's the kind of delta that we are talking about. That is the reason why the street is so excited.
Well, I guess that really explains it, right? Because we've already seen this build-up happen in stock prices. I mentioned IOC, which is up 20% this year, but even the others, you look at BPCL, you look at HPCL, you'll find gains of around 10%, 13, 14%, depending on which company you're looking at. So sticking to the fuel retailers first, Sonal, there's also an anticipation building up, right? Because of what you just said, that now it seems, and by the way, these are not numbers reported, separately on a quarterly basis or a monthly basis, but this is what the market derives, right?
Yeah.
How much profit are you making on selling petrol and diesel? That's the $1 million or $1 billion question.
That always remains a question. They never
answer it, these companies, right? But well, analysts have their own way, so that's the expectation that they are making some profit on this. And therefore, the expectations, right? Sapna was telling us last week, and then there was a remark by the oil minister as well coming in that, maybe, just maybe, it's not confirmed that maybe we'll see a fuel price cut. Could that maybe derail the rally? What's the view?
That could actually, because right now they are making profits. They have reached those normalized levels of profits after massive losses in FY23. So JP Morgan, for instance, they say they do not see a retail price cut yet, despite us getting that indication. That's because they're still not out of the woods. They've just reached their level where they can just stabilize at those levels. And remember, the government had also had to announce 30,000 crore rupees of subsidy because they were making such losses in their marketing segment. So while Morgan Stanley did indicate in their Friday's note that there could be a 2 to 5% cut, and if that cut does come about, then they will need that 30,000 crore rupees subsidy for sure. That means that that cut could be negative for these companies. They could claw back into losses again. So that is something which could, again, as you said, derail the rally. But that remains a wait and watch because of what Mr. Puri also said, that if international prices remain stable and it doesn't rise, then a lot of variables here, as he has quoted as well. So
I want to extend that quote.
Yes.
He goes on to say, we'll try and put this up for you as well on your screens. He says, if the next quarter goes well, aane wala samay theek hoga. They will be in a position to look at things. So I think the market wants to believe that there will be no dramatic or drastic fuel cut. The companies will be allowed to perhaps, carry on.
Again, that depends on how recently there was a surprise cut from OPEC+. So you never know which way things go. But right now, because of demand concerns in China, crude oil prices are at that $75 a barrel mark. Again, Morgan Stanley does say that even if the crude basket goes to $90, they will still make profits in the marketing segment. They have that leeway because they have the cushion. They have seen levels of 115, 125 on crude prices. So 90 is still okay. But if they don't cut prices, definitely a bigger positive for these marketing companies. If they do, bigger positive for consumers.
Okay, fair enough. So now let me extrapolate back. So there is the fuel retail segment, that's, you know, the absolute end, the consumer segment. There's also refining, right? At the end of the day, these are refining companies. So what is the outlook on refining margins? What are brokers saying about that?
Okay, so quarter 4 was driven by the refining segment for all these companies. Look at their GRMs. BPCL $21 a barrel, HPCL $14.1 a barrel, IOCL $16 per barrel. All of them higher than Reliance's GRMs. Reliance always has had a premium to the oil market.
Always had the industry leadership position on
correct.
GRMs.
But this time around, these companies went ahead, and it perplexed, I would say, the entire analyst community as well. They were not sure what led to these margins, but yes, refining is in a good shape right now. Number of reasons. Crude prices are lower. Secondly, they have been using Russian crude. So that's what one of the analysts says, that the blending of Russian crude in their overall sourcing mix has really helped their margins this time. Crude prices are lower as well. So they are at around $75 per barrel versus $95 per barrel in 2022. Thirdly, we are seeing increasing demand for diesel. Earlier, it was suppressed because diesel is mostly used in the commercial segment. Until 2022, yes, things had picked up, but they've picked up even further in 2023 from the commercial side. So that means that diesel cracks or spreads, so to say, they are doing well. Diesel was one where there was still some, I would say, negative spread which was reported by the company 2022. That has recovered substantially, and that is working well for GRMs. And it is expected that even quarter 1 will be good. Now, after these stellar numbers like $21 a barrel.
$21 of GRM kind of,
I've not heard since the time I have actually started tracking the oil and gas space. So that is really strong. And it is expected it could continue in quarter 1 as well. So that is the other positive which is working for the oil marketing companies.
Seems really good. Whether, I mean, even if they have to cut fuel prices here and there with these kind of refining margins, maybe, it can kind of offset. Let me then turn the spotlight also on the gas space, which you've been telling us so much about, because I think some of the notes that have come in are sounding very optimistic on gas companies. But I want to start with the basics because so much has changed, right? There's a new pricing policy that's in the works. We know that international gas prices have been cooling off. So what are the variables and what's the immediate environment looking like?
So ideally, say for gas producers like oil and ONGC, if gas prices are low, it's not the best thing. But the government has structured it in such a way that they're still earning margins above their costs. So that works well for them. $6.50 per MMBTU is the cap. That is okay for them, and that's why it's not such a big negative, the news that had come by. Now, that is about domestic gas pricing. The second is LNG prices, because 50% of our consumption is imported in the form of LNG prices. Last year, they were at record high levels. In fact, they reached levels of $54 per MMBTU, which was never seen earlier. Now, it has come back to $14 per MMBTU. So, because LNG prices were higher, imports were costlier, and that's why we did not import much of the LNG because it was costing way higher. Now, as per a CLSA note, this time around, LNG demand was higher by 5.7% on a YY basis, 10% on a month-on-month basis. Now, remember, last couple of months, it had been on a declining trend. Now, if LNG imports increase, it is positive for companies like Petronet LNG, which import the gas and they actually supply it in the Indian market. It is positive for the likes of GSPL, GAIL. They get the gas at a lower cost, right? So it bodes well.
The cost of purchasing goes down for these importers.
The second thing that CLSA says is that there is higher gas consumption, domestic consumption in the country, which is also coming from higher gas production domestically. So, of course, that bodes well again for all these companies. The third thing that's working really well is the infrastructure upgrade that is happening. Pipelines are getting commissioned for, of course, supply of gas across. Tariffs are getting increased. We have been speaking about GAIL tariffs going higher. It bodes well for these oil and gas for the gas companies, I'm sorry, GAIL and GSPL, because they will be getting higher revenue because of higher tariffs.
These are pipeline tariffs that you're talking about.
Pipeline tariffs, yes, because they take the gas and then they supply it across the grid. The third segment in this is city gas distribution companies. Of course, $6.50 per MMBTU came as a huge relief to all these companies. They were like, okay, our gas costs have come down. In fact, Mahanagar Gas CEO told us if this price cut hadn't come, they would have taken a hit of around 8 rupees on their margins. That is a big hit that they would have gotten. So that is, low gas costs are definitely working really well, plus infrastructure upgrade and tariff hikes that we are talking about works across, be it utilities, be it city gas distribution companies, or be it the pipeline operators. It works well across the grid.
So it's actually turned out to be a win-win, this new pricing mechanism, right?
And that's why
Producers and the consumers at the end of the day.
Exactly. That's why we got positive commentary across, despite that price cut or price cap, so to say, because it worked well across all the segments.
Oh, the government's actually managed to satisfy all ends of the spectrum. That doesn't happen all the time. Usually there's someone left out in the cold. So just to sum things up, I mean, given all the brokerage commentary that you've also picked up, largely it seems to be a pretty buoyant outlook or a pretty optimistic outlook on the entire sector then, so to speak.
Yes,
right?
yes. And largely led by, again, there are some caveats because we don't know how crude prices will move. So crude pricing is very important in this case. If it remains at these levels, then the oil marketing companies or the refiners will continue to do well. Even at $75 a barrel, the oil producing companies are making decent profits. $75 to $80 per barrel is fine for ONGC and Oil India. So at this price, everyone is happy. Similar is the case for gas companies as well. $6.50 per MMBTU, which is the cap right now. That bodes well both for the producers and the consumers. And the next thing to watch out for will be very company specific. For HPCL, for instance, they have a very high debt. In some of the refineries, the utilization is not very high. For IOC, the next thing would be they have a petchem segment as well. Petchem has been doing well, but in calendar 2022, there were negative spreads in petchem. So that is a company specific thing that we'll be watching out for. BPCL, I don't know what's happening with divestment, but of course, people are still talking about it, but you never know. That again is in terms of what their refinery utilization is. So overall, the sector theme is very strong. Then if there is something company specific, that we'll track.
And of course, me personally, I will be watching out for when those petrol prices will come down, if at all. But this is very helpful, Sonal. Thanks very much for explaining this to us. Kind of demystifies this whole rally that we've seen in the oil and gas space. So thank you for joining in. Well, with that, we will take your leave on this edition of Who Moved the Market. Hope you found that insightful and interesting. Keep sending us your feedback and comments. See you again tomorrow with another theme.